Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, we bring you the highlights from our annual Morningstar Investment Conference and more. Our conference is host to advisors, economists, fund managers and academics covering vital and topical issues impacting savers and investors. Let's get started with our first guest on the podcast, Stupnytska, global economist for Fidelity, who warns that global growth and reflation trade has peaked. So should investors be concerned about a global downturn?
Hello, Anna.
Hi, Emma.
So you've just spoken here at the Morningstar Investment Conference about global growth. Potentially, global growth is peaking at the moment, which is very different from what we're expecting in the US, where we've got President Trump saying he thinks he can add to GDP of the US and indeed globally through his policies.
We're definitely seeing evidence that global growth has peaked. It's still positive, still at decent levels, but it's decelerating. Inflation has also peaked on the headline because of the base effects from commodity prices. So this reflation story that markets were excited about a few months ago has now peaked. Now, moving ahead, I'm not saying that growth is going to decelerate, we're going into imminent recession, but we do need some kind of catalyst for reacceleration. And in this respect, yes, maybe Trump's policies will be that catalyst. But firstly, I think it's more a story for 2018. And then second, do we really want fiscal stimulus coming at the wrong stage of the cycle, at the late stage of the cycle, where it can potentially prove to be quite inflationary? This will make the Fed more aggressive in terms of tightening. It's not going to be good for the US or for global growth.
Or for consumers, because of course if rates go up, then all their loans go up too, and that really squeezes the consumer, doesn't it?
Yeah, actually interesting in consumers in the US and the UK as well already facing headwinds. If you look at the US consumer, the real wage growth is zero or negative because wages in nominal terms have been stagnant, inflation accelerated somewhat, and at the same time the housing market, which is kind of a big support for consumer, is also seeing falling housing affordability because house prices are back or even above the pre-crisis levels, and mortgage rates are rising as well. So the consumers globally are already feeling the pinch.
Of course, the US is a big piece of the pie, but it's not the entire pie. China increasingly has a huge impact on global GDP. What sort of impact is it having at the moment?
Well, China worries have been out of the headlines now for a year or so because they stimulated the economy dramatically a year ago in terms of fiscal, in terms of monetary stimulus, and suddenly all these China concerns have gone away. Now they're back in the headlines and they're coming back very slowly because it's obvious that the fiscal stimulus is fizzling out and the monetary policy is tightening, not just in terms of actual monetary policy indicators and variables, but also from a regulation perspective, which is very hard to quantify, but it's tighter, and you can already see some signs from the markets, for example commodity markets, are showing that something is wrong in China. And I think we are going into the next stage of a China slowdown. The question is how fast it's going to be, but in any case it will affect emerging markets and it will affect global growth.
Now, global growth is of course economics, and people often say that economics and stock markets are not closely affiliated. One does not necessarily impact the other. But in one way in which it does is monetary policy. And we have seen an incredible amount of money flooding the markets since the global recession. That's started to come back now, hasn't it? Which should affect stock markets and people's portfolios.
Definitely. I think this is the first year since the global crisis where we're going to see less liquidity pumped into the system and not more. Even last year we had more QE from the ECB, more QE from the BOE, more QE from the BOJ. This year, no more QE. The Fed is tightening. The ECB is about to start tweaking forward guidance and move towards some kind of normalization of policy, which is not going to be very fast, I think, but they are moving in the direction. The BOE might be tempted to get a little bit more hawkish given the economy is doing okay. So all these big central banks are moving towards a more hawkish stance, less liquidity in the system, and of course for all the markets and which have been so addicted, so attached to this liquidity, it could be potentially quite a disruptive event.
Anna, thank you very much.
Thank you.
Why are markets not reacting negatively to bad news? Stock markets hate uncertainty, or so we're taught. But the last year has seen considerable political uncertainty and markets have rallied. We speak to Newton's Iain Stewart, investment leader for Newton Investment Management, to find out why.
Hello, Iain.
Good morning.
So over the last year, we've had several macro results which have resulted in the markets doing the opposite of what we might expect. Brexit, for example, Donald Trump, and indeed even this week Macron being elected saw stock markets in France and across Europe fall when we think they would be positive. So why are we in this environment now where markets seem to do the opposite of what we expect?
Yeah, I think we think it's because of continued support from central banks. So, as you're aware, we've used a lot of unorthodox monetary policy over the last few years, and that's been expressly designed to support markets and to inflate them. And because it's kept going on, investors have become conditioned to that. And in fact, I think they almost anticipate that if there may be something bad going to happen, then the central banks will come in again, or maybe even inject liquidity ahead of it. And I think that was probably what we saw through 2016, that at the lows there was a huge ramping up in the aggregate asset purchases, which is another way of saying money printing by central banks. And that allowed markets to breeze through some of these, what one might have thought were sort of calamitous events.
And how do you invest in that kind of backdrop? Do you assume that it will carry on going forevermore? Or do you have to take a difficult pill at some point and think central bank's going to stop propping this up?
Well, we're investing for absolute return, so we're really not keyed into thinking about what the stock markets are doing. We're trying to invest for our investors in a target return basis, and relatively low but incremental returns. And our approach is to try and balance the return that we can get from risk assets with capital preservation. So if we can incrementally get a bit of return, but if markets are weak, we don't capture all of that, then we can make a better return in the long run. But really, we think that the sort of euphoria that we've seen in markets as a result, we think of excess stimulus, makes us very cautious. So we are very hedged. Perhaps too early, perhaps we've been cautious too early, but we do think there's a lot of tensions building, and low volatility is quite often followed by periods of high volatility. So that would give us the opportunity, we think, to invest on a better basis for our investors in the long run.
Because we have seen incredibly low volatility. I mean, one of the first things I was taught when I first started covering investment was markets do not like uncertainty.
Yeah.
And yet markets have been pretty sanguine about uncertainty over the last years. So do you think actually this is giving people false hope and we should be prepared for a lot more volatility in the short to medium term?
Well, yes, I think we would agree that we will have volatility in the longer term. And in a sense, you're right that high levels of valuation, which imply high levels of certainty, are coinciding with very low levels of volatility. In fact, levels of volatility that were last seen in 2006, for example. And that was the period where investors were starting to believe that, as Gordon Brown said, there was an end to boom and bust. And so that gave them the confidence to put in more gearing, to lever more, to add more debt. And in a way, we've got a similar situation now. We think debt growth is very rapid, particularly in some of the developing economies like China, and that low volatility encourages it. So inevitably, if some of those debts go bad, which they can often do at the end of a cycle, then the volatility that we'd expect will come about.
So Gordon Brown said end of boom and bust in 2006, sold off all our gold, followed by market crash and gold price rallying. Is that what you're predicting? No,
we're not predicting that at all. Markets clearly chime, but they don't repeat in that sense. But I guess what we're suggesting is that it probably is still a boom bust cycle in our minds, because we don't see that underlying economic activity is really responsible for the sorts of levels of prices that we've got in financial assets. So some sort of readjustment of that would make sense. And then that gives us an opportunity to invest with better expected returns, because the higher the price that you pay for an asset, broadly, the lower return you can expect on it.
Iain, thank you very much.
Thank you.
The textbooks tell us innovation is good for the economy, but as robotics and technology disrupt the status quo, could your portfolio returns be impacted? James Dowie, Chief Economist and CIO of Neptune Investment Management, is up next to discuss how tech innovation could damage your portfolio returns.
Hello, James.
Hey, Emma.
So technology is both a headwind and a tailwind, I think, for economies and indeed portfolios. If we can perhaps start with the opportunities that technological advancement provides.
Well, the textbooks tell us that tech is good for us, and it's as simple as that. And history does bear that out in terms of the very big picture. So technological change has been very rapid since the British Industrial Revolution in the late 18th century, and we've seen alongside that a huge tech dividend. So back then, we were all very, very poor on about £1,500 a year. Today, we're on about £30,000 a year, and that's almost entirely due to tech. So tech is good for us, but at the same time, it has a dark side. At Neptune, we're very conscious of two risks that tech poses to investors. First is the risk that tech hurts their wages. In the case that that technology automates some of the jobs that they do or replaces some of the tasks that constitute their jobs. And second, there's a risk that tech hurts their portfolios if it kills the companies that they're investing in. So there's this very much two-sided case for tech when we're thinking about its impact on our living standards.
If we start with the first one then, I suppose that's a kind of the rise of the robots, this sort of sci-fi concept that a lot of jobs will indeed be placed by robots where they used to be done by humans. This is already happening, a lot of factory work, automation. Are there particular sectors where you can look? In fact, I read an article once that journalism is one of those few places that can't be replaced by robots, which I hope is true. But are there particular sectors where you think, actually, that's safe, that is not going to be affected by robotics?
I think that the impact is going to be pretty pervasive across the entire economy, because what we're seeing right now is machine learning, which is computers programming computers. So we're going to be increasing the cognitive content of what's automatable. What I would say in terms of tech-proofing your career or your children's career, you want to be looking at sectors and occupations where, as the price for those ultimate goods and services comes down in the economy, actually the demand for them goes up over time. And I think there's one very obvious sector where the case can be made very strongly for that, and that's healthcare. We currently spend less than 10% of GDP on healthcare. Looking at 20 years or so from now, I wouldn't be surprised if that represented around a quarter of GDP. So healthcare, very price elastic, and I think that's going to be a huge growth sector and probably a good sector to aim one's ambitions towards.
I think that's a really interesting point, because when people think about tech stocks, this is something your colleague Iain has said before, they think Google, Facebook, Snapchat, but actually technology is much more pervasive than that. It's actually in every single sector, isn't it? And what we consider as tech innovation and tech investing is going to be a lot broader in the future. Yeah.
So at Neptune, we think about the global economy in terms of sectors primarily. And you've got a tech sector and then you've got every other sector. But we've reorganised our research team, our research capabilities over the past couple of years so that we think about tech on a sector by sector basis, and that's how we research it. And I think that it's absolutely essential that good active managers think about the impact of tech on a portfolio in those terms, sector by sector, who are the winners and who are the losers, as opposed to perhaps just thinking simplistically, oh, I should overweight the tech sector.
James, thank you very much.
Thanks a lot, Emma.
Up next, businesswoman, campaigner and co-founder of SEM Direct, Gina Miller, tells senior editor for Morningstar.co.uk, Emma Wall, why she went to court over the Brexit vote and how the European Union will benefit from the UK leaving the EU.
And how do you go from fund fees and fund transparency to Brexit?
I was actually on the road from the October before the June referendum vote, and managed to fall out with both sides because I felt that the Remain messaging was too binary, too alarmist, and I really wanted them to talk about remaining, reforming and reviewing our membership, because there are many things wrong with the EU that need reforming. And I think if we look at where we are now, the unfortunate thing is the benefits of us leaving Brexit could be that the EU benefits from that reform, but we won't be in it to benefit from that, which I think is one of the failures of what we've done, but we are where we are. I was trying to talk about accountability, talk about the fact that politicians were lying, and this was not about the country. This was about healing the Conservative Party. So just asking questions and going to the lion's den around the country. And I was absolutely convinced that we were going to leave 2-3 months before. And that filled me with horror because I didn't believe there was a plan on either side. And when the government started talking about the royal prerogative, I studied law. I'm not particularly clever. Any first-year law student will tell you they learn about the royal prerogative and the sovereignty of Parliament. So it was, how could the government use the royal prerogative? It's against the law. So I simply went to court and asked the question. It was not about stopping Brexit. It was actually preventing our government from setting an incredibly dangerous precedent because we don't have a written constitution, which is that any future prime minister could use the royal prerogative on the domestic plane and bypass Parliament and take away any single right from any single one of us. That was what I was fighting for.
And you very much became the face of that campaign, but it was a wider group of people, wasn't it, behind that? Perhaps you could tell us about how they came together.
It was very interesting, this idea that I put myself up as being, the face and seeking publicity, etc. So on the 19th of July, there were 6 cases that went before Lord Leveson, and he chose me as the lead claimant on my case for 2 reasons, actually 3 reasons, I think. One is, we were very, very careful to make our case a black letter of the law. We did not involve any political statement in our case. It was purely a constitutional case. Secondly, ironically, we followed process because some of the other cases were so eager to get into the limelight that they applied straight to court, and you can't do that. You have to do something called a pre-action letter and follow protocol, and that's what we did. And thirdly, because I think I bagged Lord Panic, who is one of the best minds, and the courts wanted someone who could argue a very important constitutional case. So the courts made me the lead claimant. I did not appoint myself to that position.
And how was that process? Because, of course, there was initial success, and then it faltered slightly, didn't it?
How did it falter?
Well, there was initial success in that it was voted through, and then there was some pushback.
No, the court case was a resounding success. What happened after that is spineless politicians didn't do the job. They basically voted against themselves. You know, to have voted against the 2 amendments, one is EU citizens, which is just the right thing to do, and secondly, against a meaningful vote, is just pure and utter nonsense because they've basically, logic and common sense says, nobody can see into the future, nobody knows what's going to happen. Why would you not want all options on the table so that you can make a choice and vote on that? So, for whatever reasons, and there are many reasons, I believe, yes, the MPs, bearing in mind what I invested, I feel that the Labour Party in particular, I should not have had to bring this case. It should have been, they are the questions the opposition was supposed to ask, and they didn't, and they're still not asking.
Gina Miller, who also founded the True and Fair campaign against too high fund fees, is up again to tell us about her new campaign to encourage tactical voting in the upcoming general election.
And what about the opportunity we have now with this election coming up? I know that you've launched a recent campaign in order to make Brexit quite a deciding factor in the election for those who want it to be.
I haven't made it a deciding factor. The Prime Minister has made it a deciding factor because this idea that she needs a bigger mandate, she doesn't, she has a mandate. I think the most sensible thing that can happen now, we are all leavers. This whole idea of talking about Remain is just distracting. I think it's about choice, and common sense and logic says 2 things to me. One is we should immediately be negotiating a transitional period because all 27 member states have to agree that. So that should be the first thing that happens. The second thing that happened is we should not be using EU, on both sides, EU citizens and expats as bargaining chips. And thirdly, I think we should be, the candidates we should be backing in this election are the ones who are going to back a meaningful vote at the end of the negotiated period.
And that's quite different from some of the other campaigns that have come up since Brexit. We've got Stanley Johnson, who's saying his son Boris was wrong, and he's launched something called Environmentalists for Europe. There's MEP Annalise Dodds, and even Tony Blair, who wants MPs to publicly admit how they voted themselves before going into this election. You know, what do you think of that kind of campaign versus what you're...
I'm a realist. I don't understand. I've never been somebody who understands why you look back. What's the point of wasting your energy doing that? We are where we are. It is absolutely shameful that they're distracting. We're not doing the things we should be doing. We're not talking about education. Every all-party committee has been suspended. No work of government is happening. And, you know, the waste of time and effort at the moment is quite shocking. And the fact that it's all for, people call elections to power grab, that's it. There's no other reason. And, you know, Mrs. May is extremely wily, extremely clever, and why wouldn't she do what she's doing? But it's unfortunate because it's very distracting. And, you know, if you look at the timelines of what's going on in Europe, the true negotiations won't actually start, it looks like, until after October, which gives us less than a year if we don't get that extension. So I just think the emotion needs to abate, and we need to be, all of this needs to be on a much more reasoned, common sense, logical basis.
And perhaps you could tell me a bit more about Best for Britain, the new campaign.
Best for Britain, we're trying to do three things. One is to say to young people that this is your adult professional life, this is your future. If you, there's no point you sitting there and complaining, you actually have to use your voice. So today we've signed up with three organisations, one called Bite the Ballot, My Life, My Say, Citizens UK. So we're targeting 1 million youngsters today. We did a massive YouTube blog campaign yesterday to get them out to vote. Secondly, there is an apathy. People are really quite fed up of referendum, elections. You know, we're trying to get turnout up. And thirdly, to identify those candidates, apolitical, in marginal seats, who will back a meaningful vote at the end. So realistically, probably about 30 to 40, and try and reduce that landslide majority that everyone thinks. A lot of pollsters and experts are saying it's not possible to do what we're doing with Best for Britain. In 2015, in Canada, it was a foregone conclusion, apparently. And we were in almost exactly the same situation, and a very similar campaign started, albeit they had 9 months, we have 4 weeks. And even Prime Minister Trudeau himself says it was due to that campaign that he came to power. So we will lose when we stop fighting, and we won't stop fighting.
If you think the UK is just divided into Leavers and Remainers, then think again. There are more complex political factors at play, says YouGov's Joe Twyman, up next.
Hello, Joe.
Hi.
So we've just heard from you in your presentation at the Morningstar Investment Conference that there are divisions across Europe, and they're not just about whether you want to be in the EU or not. Along what lines are people increasingly divided?
Well, that's right. In the old days, people would talk about things in terms of left and right, liberal and conservative, and now people think about things in terms of leave and remain. But actually, it's a lot more complicated than that. And there are a number of factors that really define these new groups that we're increasingly looking at in order to understand the country better, not just here, but actually across Europe and developed democracies as well. So that's things like age. The differences in age can have a huge impact on things. Education, social class, but also the way that people look at the world around them. And so some people may look very much inward and see their country as where their future lies. Others will see a more international perspective. And so the contrast of all of these and how they interplay together is really starting to provide a much greater level of detail for the population.
And how important are these divisions when trying to predict the outcomes of the various political decisions that have to be made in the next 12 months?
Well, massively important, because the world, and particularly the political world, has changed over the last 2-3 years. And things that one would not expect to happen based on historical precedent, based on a lot of other information, have indeed occurred, whether it's Brexit, whether it's the election of Donald Trump. And the reasons for those are complicated, but they are linked to the fact that the country is now dividing in different ways. And so there is a group of people within both our population in this country, but also in other countries, who feel that they are dissatisfied, distrusting and disapproving, not just of politicians or political parties, but of political institutions and often the establishment as a whole. They feel that they've been left behind and that the world has moved on in a way that they're not comfortable with, and crucially that they did not consent to. And the implications for that in terms of how the established political parties address it, be it for a referendum campaign or for a general election, are enormous.
And why is it such a surprise that these divisions exist? Because you certainly saw over the last 12 months, as you touched upon, Brexit was not an outcome people were predicting. You know, Donald Trump was, again, not an outcome that the polls predicted. And yet here we are in this political landscape where it's very evident that people are angry. Why were we not aware of that before?
Because in a lot of cases, it's more complicated than simply anger. And so the story of the last parliament in this country was about the rise of UKIP and going from 3% in 2010 to nearly 4 million people voting for them in 2015. And that growing anger, that growing dissatisfaction, distrust, disapproval was very clear when it was manifesting itself in terms of voting for UKIP. And it was pretty certain that the vast majority of those people would then vote to leave the European Union. But the fact that the referendum on the European Union became a referendum on really modern life in general for a lot of people, and became a referendum on the establishment, on the established way of doing things, meant that it was far more difficult to predict, because ultimately it's just a lot more complicated.
And have we reached peak dissatisfaction, or is this just the beginning of something that's going to stretch far out past June the 8th and into other political elections?
When you look at opinion data across all different measures for this sort of thing, what you're interested in, and not the individual polls and the small fluctuations or the outliers and everything else, what you're really interested in is identifying the long-term trends. That's what's key here. And so as a political analyst such as myself, I'm looking for the distinction between talking points and turning points. The difficulty we have at the moment is that it's too soon. And we don't know whether Brexit and Trump are the turning points or the talking points, or whether, for instance, France and Austria are the turning points or the talking points. We'll only know perhaps in a number of years' time, but it's one of those questions that we're now focused on heavily.
Prediction for the general election 2017 in the UK?
It'll take place on June the 8th.
Thank you very much, Joe.
Interest rates are rising, but bond prices are falling. How do you find fixed income opportunities in an environment like this? We talked to Jupiter's Ariel Bazalel to find out more.
Hello, Ariel.
Hi, Emma.
So you have called the juncture that we are at right now the perfect storm for bonds. Why is that?
I think for risk assets in general, we're at a really interesting moment. Since the global financial crisis, it's the first time where the major central banks of the world are quite literally together now tightening policy. Now, risk assets have been on this fantastic bull run, driven by primarily the fantastic amounts of liquidity that's coming to markets. Now you've got the Federal Reserve determined to raise rates. You have the Bank of England stopping buying corporate bonds. You have the European Central Bank now tapering back on their QE program. The Bank of Japan are doing some sort of stealth tightening program as well. And the People's Bank of China are also more recently have also started to tighten policy as well. So it's quite an interesting juncture, and I think we may have quite a volatile second half of the year as that punch bowl is slowly being removed from the markets.
That means basically that rates are rising, but prices are falling. How do you find opportunities in an environment like that?
So the picture I'm painting here, in terms of what investors should be doing, is start to think about increasing the quality of their portfolios ultimately, start to take some profits. And within bond markets, what are we doing? We are increasing the quality of our credit portfolios by reducing our high yield exposure. And with our belief that we're set for a more volatile period, and also the economic data is becoming a bit more mixed. So whereas earlier this year, it was all guns blazing across the major economies of the world, you are beginning to see signs that things are slowing down in some of the major areas like the US and China. And so with that in mind, we think it's time to actually start to, and this is somewhat non-consensus, actually start to scale back into government bonds. We think that, a disinflationary or deflationary shock is now more likely than a reflationary shock.
Moving up the quality scale will be music to many investors' ears who have been forced to take on more risk than perhaps they are comfortable with over the last decade because, low-risk assets simply weren't paying. Is this finally the beginning of the end and we're going to see that reversion into the old norm?
I don't know whether it's the beginning of the end, but look, what I would say is that this is the problem with QE. And in my opinion, the reckless policies of central bankers, unfortunately, because of 0% rates or negative rates in the likes of Europe, it's led, in my opinion, to a massive misallocation of capital. People aren't calculating the risks well, and so people have been piling into assets like bonds, especially into high yield or CoCos, into property, into equities, just to get that bit of yield without really thinking through the risks involved. And like I said, I think with this incredible run assets have had, combined with valuations, so for example, this is the third most expensive equity market in US history, according to some metrics, it's just time to scale back the risk.
Ariel, thank you very much.
Pleasure, thank you.
Would you rather £100,000 now or £150,000 in 10 years' time? Can you overcome behavioural bias and wait a decade for a larger amount of money? Pension Freedom's drawdown rate suggests not, and our survey we took on the streets of London confirms it.
Would you rather have £100,000 now or £150,000 in 10 years' time?
I'd rather have it now.
And why is that?
Invest in it and then hopefully getting greater returns than the 50,000 in 10 years' time.
100 now.
£100,000 today.
I think 100,000 is much better.
So I'd probably just get the 100k now, and I wouldn't know where I'd be in 10 years, so I could probably use that now, save it, invest it, and if something were to happen to me, at least I'd still have it.
I'd take the big amount now. You don't know what the future holds, and I hate to interrupt you, but my bus is coming.
That's fine. Probably the money now, yeah.
At the age of 71, I'll have 100 grand now.
To quick calculation top of my head, 150,000 in 10 years' time is an annual return of about 4%, which at the moment is quite tempting. But maybe I'd make more on the stock market. I'd say it's finely balanced.
I would prefer to have them now. But maybe that has to do with my age, I don't know.
Probably now, because I could do a lot of things with that much money.
Yeah, I think I could wait 10 years for an extra 50k.
£100,000 today.
And why would you rather the small amount of money today?
Because, I don't know, maybe tomorrow I can die. So I will enjoy my money now.
The world may not have that long to go. So take the 100,000, book into the Ritz, have a good time.
100 now.
Why?
Because I might not be here in 10 years' time.
Yeah, a bird in hand is worth two in the bush. I don't know where I'm going to be in 10 years. And, it'd be like, oh, well, you're giving this to your grandkids. Like, no, I'd rather take the 100,000 now.
Yeah. And what about whether you'd rather £100,000 now or £15,000 every year for 10 years?
£100 now, £100,000 now, yeah.
And what would you do with £100,000 now?
I probably would give it away. I don't need it.
100 now.
Why would you like 100 now?
I could do something with a lump like that rather than having it drip fed over 10 years. I think I could make it work better for me now if I was given a lump sum.
I think I'd still rather go for the 100,000 now, because I could use that and put that in interest-bearing account or something like that and earn greater revenue.
Yeah, I think I'd go for the lump sum now. Cash?
Yeah, if you want it.
Right, okay, I'll go for it.
Oh, would it surprise you to know that you're the only person I've asked? I've asked 10 people, and so far you're the first person to say you'd rather the more money later.
Yeah, I think so, because I'm thinking about my friends and my family, and who I would ask the same question, they'd probably be like, just give it to me now. Yeah, I'll have it now. But I mean, that's a decent chunk more. Like, I'm willing to wait. Sign me up.
Fund fees have fallen in both the active and passive market in recent years, but the industry must be more transparent when it comes to cost, says Dr. Jonathan Lipkin from the Investment Association up next.
Hello, Jonathan.
Hi.
So I thought I'd start by setting the scene, and that is, over the last couple of years, it has been quite positive for investors in that fund fees have come down because of regulation, haven't they?
Yeah, we've seen falls in fee rates both in the active and passive market, and we see a very competitive market emerging. But we've also been clear that we think there's more to do in the context of disclosure, both of the fees and costs. And we also agree with the FCA that there needs to be a little bit more work done on the clarity of objectives and some of the reporting against the delivery of those objectives.
And I think that transparency is key, because fund fees have come down, great news for the investor, but I think a lot of retail investors are still confused about what goes into that fee, what makes up that fee, where their money is going. And I think there is some move in the future coming through which will help with that, isn't there?
Yeah, we want there to be complete clarity, and we want there to be consistency around two key points. Firstly, to be able to say, what am I charging you as the fund manager? And if the investor asks, what am I paying for the service that is the fund management, to be able to answer that very clearly, but also for there to be accountability of the costs that are incurred in investing the money. So to be clear, if you come as a retail investor and you invest in a fund, you're paying somebody to do the job that you could try to do yourself, but you've decided to entrust that money to a professional. And that professional will also incur transaction costs that you would have incurred had you tried to do it yourself. And it's important that you have accountability for both of those so that you can understand both the performance, the associated transaction costs of getting that performance, and what you have paid a professional, whether it's passive or active, to deliver you an investment return in a given market over a given time.
And I think that's really important, that breakdown, because different fund managers operate in different ways. Some will have higher transaction costs because that is the way they run their fund. They have a higher turnover, but that results in a higher performance. And others will be sort of the individuals that sit and hold. But without that information that you describe, it's difficult for investors to compare and contrast when making an investment decision. So without that information, they can't, make the best investment decision for themselves, can they?
Yeah, and we've put forward a framework now that will ensure that there's a consistent definition of portfolio turnover rate, so you can understand how fund manager behaviour may have varied from year to year, as well as understanding the transaction costs that are inherent in delivering the return. But you make the point very well. There is no inherent connection between transaction costs and investment performance. You need to be able to explain your investment performance and the associated transaction costs. And fees behave in a very different way. The higher the fee, the lower the investment return. Transaction costs do not behave in that way. There is no linear connection between the way that you invest and the return that is delivered. And I think the danger is that if you take those two pieces of information, the charges and the transaction costs, and put them together in a single number, it may be harder to understand. You'll certainly get the full economic experience of your money, but I think we need to have both of those pieces of information available. So just to be very clear, you should have total transparency, but we need to be mindful of how people might wish to use that information.
And what's the timeline for this? When can we expect to have this information in our hands?
Well, the European regulators are driving the timeline, and so MiFID II and the new PRIPS, the key information document that will be on the European regulatory front line, will be the beginning of 2018. There is new pension scheme reporting coming in the UK for defined contribution pension schemes. And if you put all of that together, you'll see a real paradigm shift over the next year. The IA code, which is intended to try and offer a consistent way through that, we hope will be completed in the summer of this year, but that is all subject to regulatory approval, particularly the outcome of the market study.
So watch this space.
Watch this space.
Jonathan, thank you very much.
Pleasure.
What are investors most concerned about? Morningstar spoke to advisors attending our investment conference to find out where they consider the best opportunities to be and what is worrying their clients the most.
What is the best investment opportunity right now?
I do think there is still value in Asia, and from the beginning of the year I was positive on emerging markets, and I still think that's going to be the space to be for the remainder of the year.
I perceive Asia, based upon what they've said there and plus what's been going on over the last, 8 to 12 months?
I would think Asia. Yeah, Asian equities.
It looks like there are some opportunities in Asia, and I thought it was quite interesting the points that Ezra made about pharma and ageing populations in China and India.
It's probably Asia. With increasing technology, that's where educational excellence is improving the fastest.
From this morning's conference, one would say that we're going Asia, or are we going Europe? I don't know.
The best investment opportunity right now, according to the speakers from this morning, are around Europe. Personally, I'd probably be looking around the UK, businesses that are investing both domestically but also diversifying across the main European mainland.
I guess I quite like the fact that the UK companies sold off after Brexit, and I think they've recovered a bit, but I think there's more to go there, so that's probably my bet.
What are your clients most worried about today?
Protecting their capital, because obviously that's the thing. We've had a great period of growth, and now we're sitting here thinking, what's going to happen next?
Possibly potential inflation.
I think inflation is definitely number one on the agenda, and obviously they want to make sure that their money's earning above inflation, especially with obviously 0.25 BP interest rates it's not a great time for savers.
Real returns, unfortunately. Yeah, I think most people are apprehensive. They see rates are going to go up at some sort of time.
I think it's just low interest rates and getting a return on their cash.
Preserving value at these the currently high valuations of equities.
You know, any kind of onward impact coming out of Brexit and any sort of longer term impact on sterling, on their investments.
I would say, the bigger picture, the Trump situation, the Brexit situation, but what they've grown to realise is that diversification is what is the safeguard to that.
North Korea, probably, because of the knock-on effect that could have on China and would get America involved and so on.
Clients are worried about risk. Certainly, I think they're worried about not meeting their objectives.
To be honest, they're not worried too much. They know that investing is a long-term process, and that's what they need to do. So, when markets dip, they don't panic. They've been well trained.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.